Welcome back. Let's get some earnings conversation now. Mindspace Business Parks REIT reported numbers. It was a good set. Dividend payout increased 6% on a sequential basis. Occupancies were also up 4% on a YOY basis. To understand more about the fundamentals and the outlook going forward, we have with us Mr. Ramesh Nair, MD and CEO, Mindspace Business Parks REIT, joining us now. Mr. Nair, good afternoon. Thank you so much for joining in. Well, it's another quarter of strong performance and dividend payout as well. But if we talk about dividend per unit on a quarter-on-quarter and on a YOY basis, it's flat sequentially but up 10% on a YOY basis. On a 9th-month basis, dividend per unit is up 12.5%. Does it give you some visibility on what kind of numbers you look at in FY27? And will you be able to exceed your guidance now in FY26? What is the number that you're looking at?
So, Sonal, typically we don't give guidance out, but look at the key parameters. The three numbers one should be tracking when they're looking at a REIT is NOI growth, which is at 29%, which is exceptional. Distribution growth, again, which is grown at close to 20%. And occupancy, which excluding acquisitions is 95.3%. So on all three parameters, we have done extremely well. Our borrowing costs, again, which used to be 8.15 in last March, has which 3 months back dropped to 7.52, is now again down to 7.39. So the interest rate environment is definitely helping us. The other thing which everyone should look at is the releasing spread, which is when a tenant leaves, what extra rental do we get from the new tenant? And that's, again, a staggering 27% releasing spread. So on all the parameters, a lot of our parks are 100% full. Many of our parks have crossed the 95% mark. So across parameters, very good.
Ramesh, thank you so much for joining us. So you spoke about how finance costs have come down significantly, almost 100 basis points. Any scope for further ratings upgrade? Can you bring that down further? And give us a sense of the leasing trends. You spoke about releasing happening at almost a 27% spread. What is the trend going forward?
So the trend going forward is we see that number being maintained, Vivek. The main reason is Hyderabad market, which 2 years back used to be a 75 rupees per square foot per month market. Today has crossed the 100 rupees. Incidentally, we did a deal recently at 105 rupees in Hyderabad. So that's definitely going to help us. So cap rates are compressing, which means this would lead to a NAV tailwind. Rental growth, again, leading with NAV valuations plus cap rate compression will give us that double leverage. That's, again, going to help us. Falling interest rates, like I mentioned, NAV valuations typically lag rental growth, which will, again, help us in future repricing. So all these things helping us, and ours is a diversified portfolio across 4 cities, which also smoothens earnings volatility. And compared to listed developers, Vivek, this is a very important point. A REIT like ours offers high earnings visibility and lower volatility. And look at the numbers in the last 1 year, which is Jan 1st to December 31st. We've given a total return of 37%. So obviously, we are the best performing REIT in terms of returns since listing. There again, we've given a return of 16.6%. In spite of all those cyclical problems of COVID, work from home, rate hikes, SEZ disruption, in spite of all that, we have demonstrated superior execution, and we have come out performing as the best performing REIT since listing at 16.6%.
So, you spoke about how things have been quite volatile. Despite that, you've seen strong growth.
Used to be volatile. So now it's
used to be. That's what I meant. Used to be, despite whatever we saw during COVID, the SEZ rules, etc. Now we are seeing a lot of contribution coming in from GCCs. Data centers is the other big thing that you are looking at as well. In the upcoming pipeline, how much of it could come from data centers? If you can talk about the kind of capex that you're looking at in terms of the new pipeline that's coming up.
So in terms of capex, it's 4,000 crores. We are actively in discussions with a few data center operators to see if we can offer more data centers within our portfolio. You should remember that we have 100 acres in Hyderabad and 100 acres in Navi Mumbai. Obviously, when these lands were acquired, the FSI, which we have totally consumed so far, is 2.9 compared to what we can actually build of 7.1. Coming back to your question on GCCs, what we have seen is GCC demand structurally helps large institutional owners like us. We have seen that GCC roles, definitely, while compared to IT outsourcing roles, a lot more stickier. They look at high skill jobs, which means they give us longer lease tenures, and there is much lower cyclicality in the GCC business while compared to IT outsourcing. So on all those fronts, and today GCCs want ESG compliant institutional landlords. All this kind of helps us retain our 54% of GCC clients, which we have in our portfolio currently.
Well, thank you so much, Ramesh, for joining us, giving us a sense of the business and the strong growth you envisage going forward as well. Well, as we now slip into a short break, the countdown